Welcome back to the Rate of Change with York Wealth Management. As advisors to some of the wealthiest families in the country, the Rate of Change is a podcast designed to help you in the pursuit of building long-term wealth through the insights of some of the brightest minds in asset management. Today, we're joined by James Rodda, lead portfolio manager at Antipodes Partners, running their global SMID strategy, small and mid-cap companies right across the globe from UK, Taiwan to Indonesia, just to name a couple. Just to give you a taste of what we're getting into today, this fund's returned 29% in the past 12 months. Since inception back in late 2022, it's compounding at over 28%, average for that period. Well ahead of the benchmark. We'll get into exactly how they've done that a bit later. Antipodes as a firm also just picked up Morningstar's 2026 Fund Manager of the Year for global equities overall. And in the category for Zenith, they picked up Small Cap Fund Manager of the Year on top of that. So, mate, great to have you on. Great to have you on, James. You guys have been clearly doing very, very well. So welcome to the podcast.
Great. Thanks for having me, Murdoch. Looking forward to it.
So why don't we begin like we always do? And, who is James Rodda and how did you get into the wild world of financial markets?
Yeah. Look, at Antipodes, I'm a founding team member. We started this business around 12 years ago with a collection of people, largely from Platinum Asset Management, led by our CIO, Jacob Mitchell. Prior to that, I guess, the history of how you get invested into stocks or interested in stocks, I grew up with my mother and my nana, both of whom weren't really into investing or anything like that. Mum was a nurse, nana was a garment maker. And I'd saved up my $5 a week for $500 and called up the radio stockbroker expert in grade 4. So that was 1994, if you want to work out how old I am, and bought 100 shares of Boral, 100 shares of Coles. And from then on, I really, I fell in love with it. Like I was reading the business newspaper every day from then on, essentially. Grade 6, just before finishing primary school, a friend who's obviously it was their, one of their parents, got me one up on Wall Street for my birthday, and I read that and I was really, really hooked. So it's sort of been, I'd say, about me. My passions are sports, stocks, maybe you can add in friends and family, and I'm a pretty narrow kind of person. But yeah, right through school or whatever, I'd spend a lot of time on looking at stocks. At university, when I was meant to be studying, I'd be in the little computer room reading, the stream of ASX announcements to see if I could find anything interesting. And so, yeah, I'm really interested. Probably the stock side that really gets me is like business and working out what's going and what's changing. That's what I like. When I see something, it's like, okay, it may be a product or it may be an industry thing. It's like, oh, that makes sense. That's going to be really big. And then you sort of translate that into how do you make money from it and what stocks should you buy? So there's a bit more to it than that, but that's basically the background from there. And I, out of university, I worked at a small family office briefly, and they actually gave me some money to manage for a period of time. I got, that was quite a good learning. They gave me 25% of whatever I made on what was a couple $100,000, let's call it, small amount of capital. And then I moved pretty quickly to the ANZ Institutional Banking Graduate Program and onto a future, effectively a CEO program there. So as part of that, I worked through the whole bank. I worked in credit risk, capital, mortgages. I worked in Hong Kong in bond origination. I worked in corporate finance prior to getting on that CEO program. I led an operational team of 25 people, processing direct debits and checks and things like that. Had to do a few weeks in the branch as a teller. It was really end to end. The goal was build a bank CEO. So you worked in every single part of the bank that made money. giving you that broad base. And I was there. I was in Papua New Guinea actually before I transferred to Platinum Asset Management.
I always find it so fascinating about how people get in because it kind of, when you agree, it kind of shapes, how you think about things. Like, some people might go the sales path, some people might go, I don't know, tech path, or they just like the macro and the patterns. But what I'm hearing is it's the businesses that kind of get your brain ticking along. Like, how does the business actually work? Like, what's the actual foundations of business? What's the product? Is there demand for it? Like, how does that, is that right? Is that
Yeah,
kind of how you see the world?
that's absolutely right. I mean, I think in terms of how we do things here, it's very industry research focused. And then that's great to understand how value is created, how value is destroyed, Porter's five forces. I think that's par for the course. What you need to do is take that industry work and work out what's changing and then deliver it into an investment. And there's always change that's misunderstood. Cyclical change, it could be structural sector change, could be socio-macro change, which we see a lot of under President Trump regime. He's changing policies, at record clip. So it's kind of, you broaden it out. It's what's going on in the world that's interesting and what's moving, and have markets picked it up. And I think, usually they're pretty efficient, but there's a lot of stuff that uh, is out there and really obvious to see, I think, at all given points in time. This is consistent. It's not something about the moment we're in now, but that really hasn't been picked up and or valued, extrapolated. And so those things become quite asymmetric because if everything keeps going as they are, you would expect a normal return from a stock. Whereas if you see, a material change that could happen or you think should happen, maybe that can totally change the trajectory for a company or an industry.
Yeah, I've always found that really quite interesting. So with Antipodes, what's the philosophy of the firm? Like, just to use an example, you chat to some fund managers and they want to know the latest, greatest. Oh, it's all about AI. Then you chat to other value managers and they couldn't care less about what the tabloids or what the latest fad is today, and they're just looking for value. Or like one we quite like, waits for essentially an entire industry to rip up, crash, blow up, then consolidate, and only then they'll actually look. And then takes forever to come back, but it's consistent. So, what's the investment philosophy of what you guys do?
Yeah. So we call it pragmatic value. So what does that mean? And it's backed by industry research. Is kind of the other key point. There's a lot more to it, but that's the basics. So we want to buy pragmatic value means we want to buy things that are worth less than what they sell for. Simple principle, regardless of the headline starting multiple. So you could buy a stock, for example, on 5 times earnings, but if it's shrinking and it's got problems, that's expensive as a value trap. Or you could buy a stock on a headline of 30 times earnings, uh, but maybe 5 years out, that's 10. Okay, so that's, you ignore the headline, try to think about what the stock is worth, take a lot of context around the industry so you make less mistakes. If you're following customers, competitors, suppliers, all of that stuff, you tend to make less mistakes. Um, so that's really it. Pragmatic value. We definitely have a value contrarian bias. You can see that in our portfolios, but also really focused on the change side. We want to be on the right side of change. We don't want to buy things that are just low multiple, because low multiple is not necessarily cheap. We want to buy things that are actually cheap for what's gonna play out over time. And then we layer on a lot of quant and old data and different things from a portfolio risk perspective. We think about that too. We do think about macro, but these are all just inputs into the process. I'd say the main thing would be industry research, um, stock level process is around um, making sure that the valuation is right for what it is, and then sort of various risk guardrails. One thing you'll see in all Antipodes funds is we have really low down market capture. So in the fund we're talking about today, in the SMID fund, that's below 40% since inception. We're coming up to 4 years, and that's pretty consistent. So we find the process makes less of those big mistakes where you lose money, and it's pretty, it's pretty, I guess, you know, it's a good performer in client portfolios. Hopefully, during those periods where everyone's desperate for someone to perform well.
How does for people that aren't familiar with value investors, like obviously, it's been around for a long time. Good old Buffett, God rest his soul's passed away. The cornerstone of the thinking. But a lot of people, do question now in current markets, how the hell does valuation, value investing work when you have, companies like SpaceX or well, Amazon's the famous one for never actually spitting out any profit, continuously losing, and then you see these market caps like where they are today. So how can people think about looking to value businesses and get into the right business? Meanwhile, a large portion of the entire market, seems expensive.
Yeah, I think it's looking for asymmetry. I mean, I think you've got to believe that in the end, the market is rational, right? And so you can point out 1, 2, 3, 10, 20 things actually at any given point in time that you don't think make sense. What you'll tend to find is someone else has a different lens. So I agree with you on that SpaceX example. For instance, say I agree with you. I'm also pretty clear on there are people that have a different view, and you've got to try to understand what that is, right? And how it could play out to become reasonably valued and become, something you make money on investing from here. So I think that's important. And again, I go back to asymmetry. Higher multiples. You may have things that may not seem to make sense, and often that's because you can see a lot of downside. So typically, those stocks we won't invest in because they're just not asymmetric. But there is a bull case out there where you make a lot of money, and the Elon Musk companies are front and center for that. They've been really good performers, whether you've held SpaceX privately or Tesla in the public markets. It's been a really good performer because the holders of the stock certainly believe something that hasn't happened yet. Um, what we would say is that the bull case may play out, but an investment in something like that, I'm just using that as an example because it's well known, is less asymmetric because we would look at that and say, well, you can actually lose a lot of money. Let's find something that has some of the same drivers where it's not priced in.
That makes a lot of sense. So why don't we get into the fund you're currently overseeing?
Yeah.
What's the just give a breakdown of what actually is the fund, how does it work, the strategy?
Yeah, sure. So it's the Antipodes small mid cap strategy. It's listed on the ASX as well via the ticker MIDS. Fund's nearly 4 years old. It's a diversified fund. So how is it different to other small mid cap managers? 60 to 80 stocks. So currently low 70s. And so small mid cap stocks are more volatile. So we think diversification makes sense. Um, we have an investment team of 30 people at Antipodes, around 30. We can do a lot of industry research. And so we invest across all 11 gig sectors. Again, most small mid-cap managers, you'll find most of their money is in 3, maybe 4 gig sectors where we're actually diversified. And what we're trying to do is pick the right things in each part of the market. So, for example, I would believe there's change going on in mining, in oil, in infrastructure, in financial services. Not all the change is happening in tech, or at the moment, industrials are pretty hot as well, right? There's stuff that's going on everywhere at all different points in time. So, real estate may be dull, but on the back of COVID, warehouse rents went up 40%, right? Or more recently, you've had data center rents go up again 40%, generally like for like on leases ending. So what's going to be next? Okay. Where's the supply demand crunch? Where is it not priced? So that's kind of what we're looking for, and there's good things in each industry. And I think what that's meant for us is huge consistency. So um, up market capture 140, as I mentioned before, down market capture 40%, and double the benchmark returns, but critically the consistency. So we've had alpha in 10 out of the 11 gig sectors since inception on a stock selection basis. And I think it's approaching 4 years now, we've had 1 month where we've lagged the benchmark by 2% or more. If you look at the category of funds in the small and mid cap space, they're making huge allocation bets. So if you go and look at the July numbers out of the peer set, all the quality funds did really well, and they've had a tough time of it over the last couple of years. And some of the growth funds did really badly. And when I say do really well, they beat the market by 5% plus in a month when they do well. We've never had a positive 5% alpha month. When I mean do really badly, they miss by 5% or more, sometimes double digit. And again, we've only had 1 month above 2% negative alpha. It was 2.5%. So what I'm trying to do is find correlated ideas with that benchmark and find the best things in each area on a belief that change is going on everywhere. And it is. That's just the reality of the world. Everything's changing everywhere at any given point in time.
What's the old saying? Skate to where the puck's going, not where it's been.
Take to where the puck's going. Just keep your eyes open, look at everything, and sort of diversify. I think is great. So,
God, I really want to crack into what you think the themes are and everything. But just before we do that, a lot of investors want to know what. So there's two vehicles. There's the retail exchange traded vehicle, and then there's the unlisted fund. So with the unlisted fund, what are the lock-ins? What are the mechanics of the fund?
yeah,
Um,
it's actually just one vehicle with dual access. So it's daily liquidity, whether you buy on the ASX via mids or you buy via the unit trust direct application via platform, however you might invest in the fund. And you can actually switch between the ASX listing to the unit trust back and forward at no charge, no tax event for the client. It's literally just the same product.
yeah, but how's it? Sorry, it's cut you off. How's it structured? Because normally when something's listed, it has a tendency to trade above and below NAV. Essentially
Okay,
with
right.
amount of
Yeah,
supply.
yeah,
So,
yeah,
are you saying you have a listed version that trades at NAV regardless?
yeah, that's right. So it's an ETF. It's not a company or a lit. So
Okay.
we just like the unlisted version. If you want to redeem units on a given day, we'll let you redeem everything. And if you want to buy units, we'll let you buy as many as you want to buy. And so we have a market maker for the listed product. There's a market maker on each side of the bid and the offer at essentially the same spread as the unlisted version, and you can just trade that however you like, and liquidity will always be there. We pay them a fee.
So it's daily liquidity even for the unlisted because you're kind of rotating
Yeah,
between
yeah,
the two, or they're
yeah,
working in unison.
yeah, yeah,
Well, that's good to know because that's been very handy. Do you remember, what was it? Not last year, the year before that, Christmas time, when the market collapsed,
yeah,
and then then you're trying to get out of a fund, and there's like 8 days or 5 days, and then before you know it, you call it correctly, and then you're off 15 or 20%. But that daily liquidity is quite
yeah.
appealing and things that are fast moving.
Yeah, that's right. I mean, I think it's a good value proposition. And look, if you're on the ASX listing, you can spend the money 5 minutes later, right? Because you'll get a credit in your account for the chess settlement. Whereas the daily liquidity in the unit trust, it might take you 3 days to actually get your cash and spend it, even if you get that price on that day.
Yeah, that's very interesting. So what are the other mechanics of the fund and the structure? So it's
At the
just daily
moment,
liquidity.
it's probably that you start to get to asset class type mechanics. So what is SMID? I think people think small, mid cap, global. They tend to think about Australian small. It's actually quite different. So the benchmark typically, we benchmark ourselves to the MSCI All Country World SMID index, and typically companies get booted out of that index above 40 billion US dollars, right? So at rebalances. So that's, I think, I've been told I don't spend too much time on the ASX. It's get you close to the top 10 on the ASX at the high end. At any given point, there's a bunch of companies well above that who've performed well. So more recently, it's like the memory stocks. Market caps might be, comfortably over 100 billion, and they're still in the benchmark.
Memory stocks. I remember a friend which we were discussing online telling me about Lamb Research.
Yeah,
That was a monster.
that's been a monster. So that one hasn't been in this benchmark for a long time because it's already a big company. But something like SanDisk, that's just gone up 20x, is still in this benchmark, even though it's well outside the top end. It'll get rebalanced out shortly. But you could think about the benchmark as 300 million US dollars to 40 billion US dollars. So a lot of, reasonably large scale companies. I guess where it becomes interesting as an asset class is when you consider, well, how does that look versus where most capital is invested of investors, which is in large caps, and it's strikingly different. Yeah.
The one other issue we find with managers, in your space is the small and mids are fantastic and everyone makes a lot of money. But then when everyone gets the headlight on them, they've done phenomenally well. Huge amount of cash pours in from every investor wanting a piece of it,
Yeah.
and then they find their fund goes from 200 million to $1 billion, and then there's not enough necessarily to buy. So do you have how much money is currently in your fund, and is there an amount which you will close the fund to new money?
Yeah, we're over 200, sort of closer, maybe edging towards 250 million in the fund. As I said, a lot of the small cap Australian managers might cap out at $1 billion that you talk to or thereabouts. Um, this asset class is a lot bigger, so when we do that same analysis, we get closer to 5 billion Australian. I
Yeah,
don't
right.
think we'd run it that large, or necessarily even close to it. But that's the difference between having the largest companies in your benchmark at $2 billion versus 60 billion Australian, right? And having way more companies. There's 50,000 companies listed in the world, so we're nowhere near any capacity. We've got lots of liquidity on available to us with and good ideas.
So with the ideas, this is genuinely a go anywhere strategy? Is there any limitations? Like, I know as an example, uranium is a hot topic.
Yeah.
You look at France, it's just like everyone's like, we need to electrify the grid, we need to get these cars going. And it's just like, cool, well, you're gonna have brownouts. The wind and sun can't run forever. And we're selling all our coal to China and they're stockpiling. We're not allowed to use it.
Mm.
So, I'm just wondering, like, you're starting to see the worm turn a touch, on the coal topic, on things that have been taboo for a while. Like, do you if it appears that hypothetically Australia, there's a new change in government and they do go the way of France and they do want, say, nuclear power stations, do you have the ability to go, okay, we would like to invest in there? Or is there a mandate saying that there's areas you kind of can't go based on public
Yeah, no,
opinion?
we can invest in that. We own nuclear. We have some. We own a company in the Nordics that is 98% either nuclear or hydro,
Oh, cool.
split between the two of them. It's an interesting story. I can tell you about it later. But yeah, we're definitely interested in nuclear. That's on the radar. We're very interested in green energy, just energy in general, I would say. We have some restrictions in terms of what you're talking about. So one is tobacco, and the second one is coal. We can invest in a company that um, is a coal company or coal power company. I think our limit's 25% exposure. If it's 50%, we sort of say no, unless there's we're really interested in pathways on things like this. So we'd look at pathways, but in general, I think actually we've said no to everything above there, and it's kind of the policy we run. And then tobacco, same thing. We can invest in a company that retails some tobacco, but once it's above 25% of their business, so I think convenience stores or something, we rule it out. Yeah.
I can't help myself here with tobacco. This is fascinating. I was traveling in the States, just came back, and when you're there, have you noticed when you're in America and Europe and Japan and everything now, no one really smokes anymore, and then they're all off the vapes because everyone knows just pure poison.
Yeah,
But what was fascinating is the company Zyn.
yeah,
Remember, it's Sweden. Then you have Velo and the synthetic version of nicotine, and all these studies are starting to come out about how good nicotine is for the brain.
yeah,
Uh, it's really fascinating. So if you remove the part that kills you,
yeah.
and you bring in the synthetic version, it's everywhere, and high performing people are utilizing it. But then we just go when we're in the States, and it's everywhere. I think on the 27th of July, Australia just banned legally importing nicotine pouches
Oh, did they?
with it was wild. They literally banned it, and this was with a medical prescription, and the nicotine products were allowed to be used as a means to stop smoking. As an ex-smoker myself, I use it. But what's fascinating is Nicorette products are still allowed because they're paying the tax, lozenges, all that type of stuff. So they're getting the tax. You're still allowed to sell Winnie Reds behind like a black door, kind of in a
Yeah,
tobacco shop. But the single cleanest form of nicotine, and there's the old snus, which is run out of a company, in Switzerland, which created this thing, is now banned, which I just found incredibly fascinating. And then, you just brought up the topic of nicotine and tobacco. Our ancestors have been using it for 1,000 years. The cleanest version has now been banned by the Australian government.
yeah. I don't know if you
That's
know.
wild.
I don't know if you know John Hebden at Bronte Asset Management. Uh,
Yes,
he owned, so that company got bought out by, it was one of the two US majors. I think it was Philip Morris out of Sweden 2 or 3 years ago. And he owned a significant percentage of the company in his funds and
really
rallied against the acquisition. And then, of course, I think he's been proven right. They've made a lot of money out of it. So they're
huge.
distributing these products. I think they're doing much better than, as you say, vapes for various reasons. And then the traditional tobacco business is kind of actually just degrading faster than it was in a lot of parts of the world. In the US, I think when you say no one smokes anymore, it depends where you are. There's a lot,
True, fair
there's a lot,
point. I
there's a lot
shouldn't
of,
do a massive caveat. I was just noticing our Pattersons are
yeah,
shifting.
there's a lot of streets in the US when I go there now. I'm shocked by the smell of the greens, the green smoke that's been legalized over there.
Different type of smoking, my
It's
friend.
everywhere. Yeah. And
Yeah, no,
that's a big change. That wasn't the case in the US
it's
10 years
huge. But
ago.
remember how we're talking, because
It's everywhere.
you're talking about memory, and how you're using memory for various software and services, but memory
Yeah.
for the human brain. And I
Yeah.
think as studies come out of France and even Oxford and a couple of places where they've taken nicotine. And I just found it very interesting. If you've got to go anywhere strategy, this is what I'm just curious with, right? So if you've got to go anywhere strategy, you can kind of do what you want. But there's rules in Australia how banning the importation of a product for whatever reason they have. Meanwhile, this company out of Switzerland or Sweden, I forget.
Swedish
Yeah,
Match, that's what it's called.
Zin
Yeah.
is one of the fastest growing entities in the world.
Yeah.
Are you allowed to invest in that if you could invest in it?
Well, it's now part of a large tobacco conglomerate. So the answer would be no. But typically we would look at that and look at it, on a harm basis. So I'd say the answer would have probably been yes if it was still a standalone entity, but it's not. It's
Just interesting.
now part of big tobacco.
This is what's fun about these conversations. Kind of go over it. Okay, well, let's get into the things that you do like. Why don't we discuss, the world that's happening today? Like, what are the themes that you're currently seeing? What are the themes you're currently seeing in the market today?
Yeah, look, I think I'll start biggest picture. This is not even a stock. The number one theme is obviously AI, right? And I think it's interesting from an asset class perspective. If I talk about the case for investing in small and mid, part of it is actually that it has less exposure to AI, and it is diversified. So I think it's really interesting. If you look at MSCI All Country World now, 32% of that benchmark is the IT sector, and then 8% is communications. So communications was always telcos, right? Now, 2/3, it's nearly 70% of that is Facebook and Google, or Meta and Alphabet, as they're now called, right? And then you got another 9% that's consumer discretionary, which used to be retailers and things like that. But over half of that is Tesla and Amazon, right? So you add that up, that MSCI large cap benchmark is now 49% effectively AI correlated, right? SpaceX is about to go into that benchmark. Anthropic's going to be a 2-3 trillion IPO about to go into that benchmark. ChatGPT, OpenAI about to go into that benchmark. So it's going to be above 50%, right? And if you look at the SMID benchmark, it's more like 16% is tech. Telcos are telcos, consumer discretionary is retailers, right? In terms of the gig sector. So it's 16% versus 50. And again, I would argue in there they have more old style companies that are maybe less AI exposed. So depends who you are as an advisor, but this happens every 20 years, 30 years. The market market cap concentrates, and the benchmarks. People invest in these ETFs. So the S&P 500 is more concentrated than the 49 in MSCI, right? It's more like 57. And then you've got NASDAQ, which I think people are making a concerted decision to invest in tech if you buy your clients a NASDAQ ETF. But certainly S&P 500 and a MSCI All Country World ETF or a core strategy that's correlated, you are looking for diversification. And it's just one of those rare times in history where you're not getting it. You're getting a one-way bet on AI. Whereas if you look at the SMID benchmark, 16%, it is diversified much better across those 11 gig sectors. So get some exposure, of course. AI is changing everything. So you have to be investing across all parts of the market with AI in mind. But if we do get a 2000 situation, what I've said to a lot of people is, well, the NASDAQ peak, 18 months later, you lost 75% of your money if you're in the NASDAQ. 18 months later, you made 25% if you're in small cap value, right? $1.25 versus 25 cents. So I think at the moment, if you've got retirees that you're looking after who can't afford to lose money, you got to think about that because you're making a one-way bet in the S&P 500 and the MSCI benchmark. I think that's the big thing. There's valuation discounts in the asset class. There's a lot of other good features. But I think the main thing is it is truly diversified.
With the theme on AI, to your point, I completely agree with you. Highly saturated. It's just I also found it very interesting. The complete and utter economic war and demand for energy right now. We discussed it before, but how fascinating was it when essentially Gina Reinhardt got access to $1.4 billion in SpaceX and she knew the valuation was going to come off. It just makes me wonder the relationship of, tech and resources. China controls what, 90% of rare earths. Now you have, US just trying to pretty much lock down as much resources as possible. Meanwhile, we're in Australia. We're pretty much giving it away for free. It makes no sense. Pocock's being very loud about it.
Yeah.
But I don't know. It's just, yeah. So in your portfolio, you can, as you mentioned, you can go the resources path. Are you finding maybe the resources path is one way to kind of spread the risk and cover the bet on the demand and of energy in order
Yeah, I'd
for the
broaden it.
growth in this space? Like, what do you reckon?
Yeah, absolutely. It's even broader than that. I just think power, energy, however you want to look at it in general, is back to what we spoke about at the start. I think it's asymmetric to AI. I think there's a lot of parts of the market where semiconductors being the most obvious one, but if the capital spending increases that have happened, will continue to happen next year, and are probably being extrapolated through to the end of the decade at least. If there's a blip, if there's a model efficiency improvement or whatever it is, that spending can slow down. Whereas power, I think you get correlation to it. A lot of power, not all power, maybe not oil, for example, but maybe indirectly there's a squeeze on energy and you do get it from oil eventually. But power in general, electricity, you're getting exposure to it. It is one of the bottlenecks. There's a few bottlenecks in building out AI. It is one of the bottlenecks. And I think a lot of areas you're not priced that. So we own, for example, Fermi, which has now 4 gigawatts of energy access on a site at $5 billion. To build a gigawatt of data center now is going to cost you about 50 if you're using NVIDIA, 50 billion. So they really only need to extract 1% of the value, right, from the power they have to get the market cap back, and it could extract 5% very, very easily. We own that Nordic power producer I mentioned to you called Fortum, right? And so in Europe, power prices are similar to the US, Western Europe, but in that Nordic region and that Nordic grid, it's kind of its own grid. It's got a very narrow transmission connection to Western Europe. Power prices are a fraction of that, and they've got an excess supply. But we think it's only a couple of gigawatts of data center projects, and it tightens up, right? And they have a rule on their grid that they have to accept new applications, and we can find 20 gigawatts in the works. So you're just buying a power producer there, in this case, a company that's 98% nuclear and hydro. So both very low cost operating power production. You can buy it on a pretty normal energy multiple, and you've got this tail risk, let's call it a tail risk upside, where if energy markets reprice to where they are in the rest of the world, you might 4x your money, right? And I go on with things like that, but we've got a lot of those in the portfolio.
But the
We
resource is fascinating. What you're discussing, it makes so much sense. Like I was listening to the global head of commodities for Goldman Sachs on some podcast, and he was saying it all kind of really kicked off back in 2020.
Yeah,
And he's like he reckons that we're only a fraction of the way into it. Like the copper story, the gas story,
yeah.
like the
The
uranium
gas
story, like
story is
across the
incredible.
board.
Yeah. I mean, gas, for example, is seen as the transition energy. You can bring power up quickly and somewhat affordably, um, as opposed to coal, I guess, which is, unless you're in India or China, no one's really adding supply globally, in terms of power
Not too
production.
sure if that's a good thing or a bad thing. It's like
Well,
I get that we want to be clean, but when you have, more than half the percent of the other world that don't care, and then they're just pretty much taking all our resources and, for a one-off transaction, and then
yeah,
our house prices are going through the roof and all that type of stuff. It just makes you question life. Like what's actually right
yeah. No, we can all think,
compared to what we're actually told and what's moral and ethical. And I
yeah,
get that. I understand the argument, but then you have Newcastle, exporting more than ever and China is stockpiling it for the next 100 years. It's just, well, I don't know. What do you think?
I think it's really difficult. I mean, if you look at Australian policy, for example, where, what is it, 1-2% of world emissions? I think China brought on coal last year that, more than our installed base. India's bringing on a lot. So I just don't think we really matter, is probably the answer. So it comes down to a moral question of whether we want to do our bit. Obviously, Europe leads in that view. They've decided they will do their bit, and it's an existential, issue. So we can make a moral decision, but I don't think we should kid ourselves that we're actually going to make a hell of a lot of difference if India and China keep doing what they're doing. They're different. One's if you're being pragmatic, that's probably the way to look at it. And I actually think that, if you look at the way energy is going, we're so close. Certainly by 2050, which is the target I think most governments are adopting for net zero, will be there in terms of a combination of hydro, solar, and battery is the most likely. You got some tail risk on nuclear fission and things like that, but we should be there at a point where these renewable energy sources are much cheaper than coal and gas anyway. I think we're going to get there. I think we're going to be there in under 10 years. Could be
You
5 years.
reckon? Because we just had the Strait of Hormuz, and then you had Qatar, right? And then you had what was the hydrogen facility that does 40% of the water supply blew up.
Yeah.
And like choking off a tiny little strait. And everyone forgets that, yes, I understand, China's concept, and they are right that, if you invest a whole lot of money into, green energy. It costs a lot of capital going in, but then once you have it, it doesn't cost you anything on the other side. I do understand that logic,
Yeah.
right? But what are we now? 2026. So 24 years from now, you have a choke point on the Strait of Hormuz or something or another event, comes up and it kind of shows you, yes, there's the way of thinking, but here's the reality, gents, that, when
Yeah.
you choke the diesel coming through, then, if you want your Amazon order, she ain't gonna get there.
Yeah. I think, I think that's fair. That's fair for now. But, a lot of the reason someone like China would invest in solar is to remove their risk on those choke points, for example. I think the reason Europe's doing it is more they made a ethical, whatever you want to call it, type decision.
Yeah.
So that people do it for different reasons. But ultimately, I think the main thing you would look at is levelized cost of energy, that type of analysis. And, whilst people will come out and tell you solar is cheaper already, it's not when you think about levelized cost of energy on a 16-hour day, right? Which is really what you need, powerful. You can't just have it producing between 11 a.m. and 2 p.m. and say that's the cost. It's not really the way demand curves work. But if you did that, you'd find that a combination of wind and solar and battery is now probably within 30%, 35% of the cost of putting up gas. It's not that far away. That's the key point. It's getting there. It's not there. It's clearly not there. And things that we've put in recent years are significantly more expensive, but I think it's going to happen. What does that mean for Australia? It means, it's not positive given how we make our money from exports, and that most renewables we import because they're made out of China, right? So, these are separate topics to investing, but I think
Wouldn't
that's
you agree it's
I
probably
think that's
more
where, I think that's
likely?
where we're going.
Yeah, wouldn't you agree it's probably more likely that it's all gonna work, in unison? You kinda can't really pull something completely out of it, because
Yeah,
then the other part will suffer. Because if you look at all the components that are being made, you actually do require, resources in order to actually
well,
require them in the first place, and the circle goes around and around. Like, everyone's seen The Lion King. Come on, it's a
yeah,
circle of life. You
that's right.
can't you
No,
just
for
can't
this
you
to
can't
play out, I mean, the amount of copper and all the shit goes through the
Yeah,
roof.
yeah. Do you know what my favorite was? I
Yeah,
can't remember the book I read, but it was a journalist that tried to figure out where the source of cobalt comes from. Have you heard about this?
no,
So the cobalt comes from the Congo, and
yeah,
he went into the Congo and it's locked down. And it turns out they were doing artesian mining
yeah,
for the largest saturation. And unfortunately, there's a whole bunch of poor people with babies in the back getting cancers. And then, Google and everyone, if you ask where they're actually getting it from, they actually completely shut down the pipeline. It's a whole bunch of companies. So a lot of people that go really hoity-toity about plastic bags and plastic straws, which I can't use, the paper ones just dissolve in your mouth.
yeah,
They're all texting on a mobile phone made out of essentially, blood diamond cobalt, coming from the Congo. And it was at that particular point I just realized the entire world's a narrative.
yeah,
Oh yeah, I completely I can see people listening to this rolling over going, Murdoch, what are you talking about? But I just kind of scratch my head a little bit. I get moral and ethical. I'm all for it. And absolutely to do the right thing by people. Absolutely. But it's just I just find it very, very challenging, to look at Australia's position, and we have these rules that we need to follow by. Meanwhile, you have other players in the market
yeah,
not doing as such. And then we're
yeah.
just kind of, I feel like we're getting left behind and the cost of living goes up. And then, I don't know, our friends and families kind of suffer a bit. It's a bit of a rant, but I don't
No,
know.
I understand what you're saying. Yeah.
Anyway, but but onto making money. What other themes are you looking at? The memory stuff I find is quite fascinating. So, what other components, like the memory stuff?
Yeah, look, in the sort of AI demand stack, I think memory's a massive shortage, obviously. It's memory, power. They're the ones that seem to me hardest to solve in the next couple of years. I think there's a lot of greasing of the wheel in different other parts of the supply chain that can get things closer to where they need to be. You've seen some of the rack designs from NVIDIA. They're moving to lower memory intensity from what they initially were for the next generation coming out, 6 months ago, because they don't want to cause a compute shortage. So better to have a rack having less memory. So to a degree, everything else, one bottleneck slows down the whole process. So I think they're the ones that mainly slow things down. It's not that we couldn't sell a lot more compute like an NVIDIA chips, or we couldn't have significant more demand than what is being sold at the moment. I think we could, but you've got these different bottlenecks that slow it down, and I think memory is a real one, and power increasingly as being a big one. There's a lot of NIMBYism happening out of the US at the moment in terms of new power supply access. So, what we're going to see is small gas engines, gas reciprocators, they're called, that typically power, a pump in an offshore. One of the main use cases has been, for example, for the pump in onshore oil for the fracking. You're going to strap together now 200 of those, power your data center, right? And that's happening. And all the companies that make that stuff, those little power, those offsite power generation things like Ineo or Caterpillar and companies like that, are just saying off the charts demand. And so this is what's generally termed behind the meter power, right? People getting power on site that isn't part of the grid. That's where the explosion's going to be. And it gives you an idea about how desperate people are. There's stories around.
But that's fascinating. Can I just understand that a bit better? It's the first time I've heard about it. Like, so we're very involved in, say, the Beetaloo Basin up on the territory, right? Fourth largest, but it's taking a lot of capital expenditure to get it out. But are you saying that hypothetically, you frack one of those wells, and then a data center could lease out one of those, and the gas directly feeds into the data center to provide the energy to operate it? Is that what you're saying? So pretty much
Yeah,
like direct to source. Because the coolest thing I heard was in the States when I think it was Amazon bought land right next to a nuclear power plant to kind of get
yeah,
direct link
yeah.
access. Is that what you're saying?
That's yeah. So what I'm
Is
saying,
that actually
it,
happening
it,
places now, or is that in
it's happening.
theory?
If you go to Texas, there's big deals happening where they might have an existing pipeline 30 kilometers from a site. They'll extend it to a site, and they'll buy these little gas reciprocators, and they'll buy 50 of them, and strap them together, and they got a mini power plant on the site, and that will be used to
Wow.
power the data provider.
So, so with these gas facilities, which you can tack on to the fracking, and then which is mentioned in Texas, is that similar to? I read a couple of years ago about how you could get nuclear power stations like half the size of a football field and kind of stack them next to each other. Is that kind of what it is? And how expensive is this? A much cheaper alternative than to, like, say, stacking nuclear powered facilities side by side and cleaner, or?
It would be cheaper, but the main thing here is time to power. So these AI companies, you've seen what Anthropic's been willing to pay SpaceX, for example, right, for their chips. So there's a massive shortage. So what really matters is time to power, and nuclear is very long lead time, I guess. Here you can get power on site in 6 months, right? Faster than you can build the actual data center itself. Whereas, for example, we own Siemens Energy, which provides traditional, let's say, the turbines for a traditional gas power plant. If you want to make an order for one of those today, and you're a power producer, or you're behind the meter, a data center company, but traditionally these will go to utilities. Good luck getting one before 2031, 2032, right? It's sold out. It's sold out from all the suppliers globally. So people are having to switch to different things that they can deploy quickly. And it's more about speed than money or anything like that. It's okay. I've got all these queries on my Claude and my ChatGPT. I can't serve them. I need to be able to serve them, or my business is going to implode. Right? That's from the perspective of those companies. And so,
Makes
if
so much
you're
sense.
infrastructure like Amazon or Google, the same thing. I've got unlimited demand here. How do I power up these sites? I can't. The queue to get in the grid in the US is also now 6 years, right? You're just not going to be able to get it in your grid access if you don't already have it. So you have to go on site, what they call behind the meter power, where you bring your own power, um, or take existing grid supply off another sector. So there was perversely we owned the company, an aluminium producer in the US, Century Aluminium, and they mothballed one of their smelters several years ago, but still had the power contract, and that's been sold and on-sold. We've sort of watched it move through the chain for. It's eventually, it's going to be tens of billions of spend on AI data centers using that grid power fairly quickly because, hey, this site already had access to power.
It's almost like a royalty.
Yeah, I mean that's where the value capture is. You see it in the Bitcoin miners and all these guys. I don't necessarily think they're AI visionaries. I think just Bitcoin needed a lot of the same things, which was power, and no one was punching the grid for new supply. So these guys got in, globally, including in Australia in some parts. They've gone in and they've got huge amounts of power agreed for legally binding from the grid. Bitcoin hasn't really worked out that well, but they've still got the power, right? And that is worth a lot. That makes your land worth a lot of money. A lot of,
Wow.
yeah.
Did you say what the name of the company was, or you don't want to say what the name of the company
The
is?
behind the meter company we own, yeah, we
Yeah.
own two. One's called Liberty, and one's called Pro Petro, tickers pump. And these companies, why are they getting this opportunity? They're getting this opportunity because if you're Caterpillar, you've been selling these gas reciprocators to these companies for a very long period of time. And typically what they'll use them for is industrial. They've used them for industrial use cases. So that was the shale energy example. When you drill for shale, you need a lot of pressure on site and you sort of move from well to well. So they need to be mobile, and it needs to be remote. And so these companies have that core business of, let's call it oil services, which we like because we think there's going to be more activity in onshore oil following Iran and shortages there. We think that business roughly covers the value of the stocks. And then they got this other opportunity on the other side, which is going to be gigawatts of, they're going to provide gigawatts of energy to these data centers. And when you speak to the companies that make these products like Caterpillar or Cummins or Ineo, the former GE, they want to sell them to the companies that are going to execute well for these big clients and make their products work efficiently and good. And these guys know how to tune them. So they've just walked into this massive business opportunity. We think it's not the best business in the world. They put in $1, they might get 20 cents back year one. But the last 10 years, they can lever them up and the equity returns will be pretty good.
Yeah, that's pretty interesting. So, James, what else is currently in the portfolio that we haven't covered? I think we had a conversation before that you don't mind the banking sector at the moment.
Yeah, we've got a few banks, that's for sure. Probably two main buckets: traditional banks and digital native banks that are attacker banks. The largest traditional banks are in Europe, and what we've seen in Europe is really a big rates move, from negative rates several years ago to a couple of percent positive now. And our largest bank at the moment there is one called SocGen, which we think Societe Generale, which we think is sort of more of a beneficiary from rate easing. We acquired that mid last year. Actually, sorry, everything's getting a bit closer. Probably mid the year prior, mid 24. And we rotated UniCredit into that. So when we think about banks, traditional banks, you're looking at net interest margins, and they're often a function of interest rate settings and your client base. So we did really well off UniCredit. We multiplied our money, and really the case was the Italian banking system is not that competitive, which it isn't. And so what happened was you had rate rises in the ECB from negative rates, and they only passed on 20% of the rate rises to the deposit holders. It's called a deposit beta. And then most loans in Italy are variable. So they got all the benefit on what they charge everyone. So their spread, their net interest margin expanded materially. And by the time we sold that bank, it was a 20% return on equity business. And when we bought it, it was a 3% return on equity business. So it became a quality, on 0.2, 0.3 at book. It sort of fully re-rated, bought back those shares, multiplied its value. We actually bought the stock around $8, right? So it's been best part of a 10 bagger since we bought it. And then the reason for moving into SocGen was France is a different banking market. France is super competitive. There's all these, credit unions and different groups. And so what happened in the rate rises in Europe was they had to pass on all the interest rate increases to their customers. And actually mortgages in France tend to be fixed for 7 years. So they weren't getting the benefit on their asset side. So this was in that European banking run from, let's call it 21 through mid 24. This bank and France in general just totally missed out on the move. And of course, we could see that the front book and the back book on mortgages and different parts of the business sort of merging. We could see rates maybe peaking. We kind of had that view, which seems relatively accurate at this point. And so we saw a net interest margin expansion story there, which has come through. Not to the same degree. The return on equity is now, let's call it 13, 14% now, but definitely has come through. And what all these stories in Europe have had, regardless of, finding the best way to play it, is they had just huge headwinds from, let's call it, the European crisis in 2011. Capital ratios, in some cases, were down to below 5%, and they had to move to 13, 14%. So basically all their profits over this period of time had gone to rebuilding capital. And post-COVID, you hit that point where they had enough capital. You hit that point where all the bad loans they wrote in the Euro crisis in 2011, and they put them in a bad book on their back, they'd shrunk enough. So they weren't going to be an issue anymore. And so what you had stocks at that point on 4 or 5 times earnings with excess capital who were able to go and buy back their stock at 4 or 5 times earnings. So make
So cheap.
Make basically a no risk 25% return, say on 4 times earnings, 25% return on equity on what you reinvest, and compound at that level. Now the sector's moved on from there, but we like to look at them excess capital, which means what's the PE multiple you're paying before that excess capital they can return and distribute. And multiples are still pretty reasonable, sub 10 times. And if you're growing a little bit, which they now are, and the markets are more stable, you can generate, it's easy to see those buybacks generating 15% return on equity and compounding at that and a little bit of growth. So we still like these stories. I think interest rates are much harder now. I could give you a strong case. So we own in the portfolio a few stocks that will benefit from rate rises in banks, some that will benefit from rate cuts. I could make an argument either way. It's not, as we have at different points in time, we've had stronger views on interest rates in interest rate directions. So the portfolio is positioned more balanced for that. So sort of SocGen will tend to benefit from cuts. We own Ally Financial in the US, which is going to benefit more from rate rises, typically. So, yeah, we like the bank story. We think the sector's, you can find a lot of good stocks on sub 10 times earnings with excess capital that aren't growing that fast. So they should pay out at least 100% of their profits to you. That's a good starting point. Not much risk. So if you think about that, that's a double-digit return that should be fairly consistent, even if the market wobbles for one fear or another, unless the fear actually becomes the macro is so bad, these guys are going to lose money on their loans, and so we've got pretty conservative loan books in our portfolio. So yeah, we like the banks, and then the digital disruptors. The largest one we own, largest banking position at the moment, it's actually a company called Chime Financial, which is not a bank from a regulatory perspective, but it rents a banking license in the US and it provides deposits, accounts, transactional accounts to customers, debit cards, credit cards, loans, everything that a bank does in the US. And so this has been a really strong stock recently. It's been in the top 10 for some time now, but in the last probably 8 weeks, it's maybe up 80%. And effectively, what the play here is that all the banks in the US, so the Bank of Americas and the Wells and these guys, they don't make any money out of that bottom, let's call it 50 million Americans who earn under $100,000 a year or under $75,000 a year. And they keep all the branches open for them, or in large part for them. And so they don't really give them a good service. They charge them lots of fees and they pay them no interest on their deposits. And so you've got something like this, which comes along, and there's a few of these companies with a similar strategy, but this company has the most direct deposit customers, which is what we're looking at out of the group. This company comes along and it's basically software, right? So very low marginal cost, incremental cost to serve. It's printing 60% incremental profit margins every quarter, like clockwork, on a base that's really a quarter or a fifth of that, right? So the incremental revenue is coming on really attractive, and they're just winning customers in that lower value, let's call it lower salary, I should say, consumer space easily, because they'll give you 3.5% on your interest rates. They'll actually give you a credit card. They won't charge you any fees. If you're a bit short on your wage, they'll lend you some money for the next couple of weeks once they get to know you. And so it's just a better proposition. And we've still got that even after a big run on 30 times 2028 earnings. So we've done well off these disruptors in the past. That's the one we like the most at the moment.
That's pretty interesting. Is it a highly competitive space, or are these are just one of this is the best company in that space?
Yeah, it's interesting. It hasn't been competitive at all. So what you've seen with the fintechs in the US, been a bit different in Europe. You've had Revolut, right? Is really a
I use Wise. So is it
yeah.
Revolut, Wise, and is this similar?
Yeah, well, Revolut and Wise used to be similar. I would argue they're not similar anymore, right? Revolut is a proper bank. It does everything. You can invest and buy stocks and borrow money. And Wise is still largely a payments service, largely for international payments rather than domestic payments. The debit card is largely used for people traveling. The main way they've started to compete is they'll now offer you interest in certain countries on your deposits that's much higher than a domestic bank. Whereas Revolut is trying to compete head on with your core bank. Chime is trying to compete head on. Nubank, these are going for the consumer banking wallet, right? So that's how I would say. And in the US, back to the structure, it's kind of been that over the last decade or so of these things come up. You might have had Chime go for everyday banking, but you had Cash App, Square, and Venmo go for P2P payments. You had on the lending side, you had BNPL, right? You might have had Robinhood on investing. You had all these different verticals come up, and people stayed in their own lane. What's happening now is most of these companies are starting to go after the core transactional banker. And so I think the disruption to the incumbent banks is going to accelerate. Yes, their cost to serve is high and they don't make marginal profits out of these customers um, because of those costs. But those costs are pretty fixed. So they start losing those customers and losing that revenue will impact them at the margin, I think. But these companies are going to accelerate. And Chime is, for example, Chime has nearly 10 million people who deposit their salary in directly every month.
What's that percentage of market share and where they operate?
Uh, we define the addressable market in a few different ways. You got the total workforce, but then you segment it down by income, and then you segment it down by people who don't have a credit card. You can get it as high as 15%, or 16%. Of their most narrow. I like to narrow addressable markets when I look at it, like things that I know where they have the best product rather, and companies, whenever a company gives you an addressable market, they make it as big as possible, right? So prefer the narrow one. It's more like teams. You've got something like Cash App, which has come in. It's probably the number two. It's got maybe 3 million people getting direct bank deposits. And you've got a whole host of others that are now starting to do it. Whereas Chime, this is what they did from day dot, which is really hard. And they've recently added, an investing module and a personal loans module, right? And all these things. Whereas they had the core debit card, savings account, high interest, no fee. That was how they grew up. And I think that's the stickiest part of a wallet, maybe with your investment account, your stocks. The stickiest part of the wallet, certainly more than a BNPL or peer-to-peer payments. Stickiest part of the wallet, and so I think they'll do well cross-selling it to other areas. And some of the others, might find it a bit more difficult.
Makes sense. What else is in the portfolio that you are a bit of a fan favorite on yours that we haven't discussed?
We own. I'll just talk to the top 10 stocks. I think that's a good expression of what I like. Pakuan Jati, it's a mall company in Indonesia. So most of their malls are in Java. Uh, People forget Jakarta is now the biggest city in the world, 42 million people. Yeah, quite incredible. And so they've got some really high quality malls there. Think about them like Westfield. They are actually really high quality. The great tenants. Now, there's just not as many Hermes and LVMH shops in a country with GDP per capita at $3,000, $4,000, whatever it is at the moment. But they have those tier one malls for those markets, and they're what we might see as mid end. They're high end, nice, very high quality stores. They're growing their rents at 9% a year. They've got an excellent development pipeline. But I'd probably throw it back to you. What after this is after all expenses, what cap rate would you expect? What yield would you expect on tier one A grade malls?
6%?
Yeah,
Like something's I don't
yeah,
know. We live close to Roseville, Chatswood. I grew up with David Jones, and I've seen how that's gone. So I'm just a bit
yes,
skeptical about the space, but that's
yeah.
just completely different, I'm sure.
Well, most of the malls we've invested in a few over time globally. They have a lot more space out for the department store than the rent. Typically they're 15% of the rent. Sorry, 15% of the space, 2% of the rent. It's all the smaller guys that they make money off. But now the answer to your question is the market rate in Indonesia, if you're buying them secondhand, would be about 8% cap rate yield. And this stock that we're buying today, we're getting about 23%.
Yeah, right.
And then on top of that, so they're growing their rents 9%, it's tier one assets. On top of that, I actually think 2/3 of the value in the stock is in their land bank. That's only a third of it.
Good
No,
old McDonald's
no,
model.
no leverage. They've got a bit of debt, but no net leverage. A really strong expansion pipeline that they can self-fund through to 2031, 2032. Indonesia's just on the nose from a macro viewpoint, pretty heavily. And people are selling it, but it's a really asymmetric investment. I think I'm not sure how we can lose money on it. And I think we can certainly multiply our money. Our assessed value of the stock will be about, using market rates, if a willing buyer and seller were trading real estate in Jakarta or in Indonesia, would be 4 to 5x where it's trading at the moment.
That's pretty interesting. I like off the beaten track. People have missed something or thematics changing.
Yeah,
Yeah, that's pretty interesting. It's somewhat stable as well. People still in the shop.
very defensive position, defensive business model. That's right. They're at 99% occupancy, so it's proper high quality malls. Probably, if I gave you one more, it would be probably the largest positions. There's another real estate one. We own a lot of Brookdale. This is the same thing to what I mentioned earlier about data centers and warehouses. It's the next crunch where rents go up 40%. That's the thesis, which is senior living facilities. So where people typically spend the last 2 or so years of their life. In the US, we see the demand is driven by demographics. Everyone gets 1 year older each year, is kind of fixed. The baby boomer turned 80 this year. In 2031, they turn 85, which is the peak incremental demand. And these things are, we're going to need a lot more of them. And we can see the new builds are not building enough. And there's been a period of oversupply because people overbuilt for this demographic that we saw coming. But we're buying this company at, let's call it, $270,000 a bed. To develop a new one in the US is probably 440 at the moment and growing with inflation. All these builders are building data centers and being offered lots of money to move to the middle of nowhere and build one. So that's only going up. And with a bit of leverage, it's a property company with a bit of leverage in the capital structure. If you just trade at replacement cost, you triple your money. We think it's going to have to trade well above because there's so much demand. If I showed you the graph of supply and demand, it's incredible. And then the largest position in the fund is International Workspace Group. So probably another topical one in terms of everyone's. So this is office co-working facilities. Everyone's familiar with WeWork. It was a high-profile blow-up.
Surf Corp's big as well.
Surf Corp's in that industry. So what happened was COVID, and that's really the case to buy this stock. So what did COVID do? COVID killed WeWork, which was selling $1 for 80 cents. That's great. And COVID fundamentally changed the business model and the proposition for the company. So IWG is the number one in the world. WeWork's number two. CBRE has just acquired the number three, and there's a big distance to anyone else. But we're about 2% of office space is co-working at the moment, still very low. And so COVID happened, and what did that mean? It meant offices were empty, which meant giving leases to these companies became really attractive. Any incremental rent is great when you own an office tower and you've borrowed 70% of the money to buy it. It works on leverage, right? So you need to fill those rooms, need to fill that space. So these guys got a bunch of great deals, right? And the deals were so good that ultimately it changed the business model. So you can look at 20 years history of this company, and they basically spent $5 billion in CapEx to earn about the same in EBITDA. So I call that return of capital rather than return on capital. You're putting out $1 only to get your money back, but you get to report EBITDA, but you haven't actually made any money. And so what's changed is these office tenants were so desperate to get demand in. They said, instead of you fitting out the room, IWG, you can do it, but we'll pay for it. So the business model went from IWG contracting, say, a few floors in a building to IWG contracting a few floors in a building, but the building owner spending all the money on the fit out, and IWG still managing it, charging the customer, but IWG just taking 15%, no matter what. 15% at 20% utilization, 15% at 100% utilization. And so that looks like a hotel business model. US hotel stocks, by the way, Marriott and Hyatt and Hilton, on average, are about 40 times PE. It's considered one of the best business models in the world. And the US market is now about 65% chain. Even most of co-working is not chain at the moment. And I think there's big network benefits from being able to travel and go to an IWG facility in 140 countries that they offer. So that's a huge business model change. And what it's meant is they've really accelerated the rollouts. So if you take their pipeline, it's going to be majority these landlord-owned facilities by the end of the decade. And they give you the cohort curves. If you do sort of reasonable assumptions on that, the stock's on 8 times earnings by 2028, exit growth rate's 25, 30%. So again, you can see ability to multiply your money. Again, a bit like some of the things that we have big positions in, hard to change. So the backlog that I'm using to make those estimates is already signed with owners of office space. So all they really need to do is fit them out and find tenants.
Yeah, COVID's killed a whole bunch of businesses, but essentially kind of reset the game, reset the board, so to speak, hasn't it? It's
Reset the
just
board. AI
reset the board and
resets the
made
board
everyone
as
think
well.
differently.
Yeah.
The entrepreneur mindset, the ability to think clearly and freely has created a whole bunch of opportunities, hasn't it?
Yeah. AI, I mean, is great for this company as well. You know, a lot of smaller, faster growing companies will tend to abuse these services. But I think now there's a lot of large companies that might be growing or shrinking, and they don't want to commit to a 5-year lease with an office owner and pay for the fit out themselves. Because say they have 100 staff, it could be a shrinking company. They know in a few years' time they'll only need 60 desks, or it could plan to deploy AI to reduce staff. It could be a fast-growing company that needs 200 desks now, but wants to buy them from someone with flexibility to have 300 desks. And so that extra variability, I think, and uncertainty around the need for human labor in an office setting makes the flexibility offered by this incredibly compelling for corporates at the moment relative to, what it has been.
I've used Servcorp for years, so I'm completely familiar with it. And I couldn't agree more. Just
Yeah.
say, you know what it is. Do you know what it is? It's kind of like remember Fitness First when it first came out.
Yeah.
Like as in you had to go to one gym, you were stuck
Yeah.
if you went to Chatswood, and that was it. Then they came out with, if you pay a couple of dollars more, you can go to any gym in Sydney whenever you want. It's like, hold on a second, you go to any gym? So I can be in Bondi or this or the city or that, and you still use all the, don't have to go to the gym. There's the capacity to like have a shower, then off you go again.
Yeah.
That just like revolutionized the game, that capacity of flexibility.
Yeah.
Just in a world where you don't know if you're working 2 days at home, 3 days at home, you have to be in the ACT or wherever you're going to be it's fantastic.
Yeah.
The other thing as well, which you haven't mentioned, but the flexibility to work interstate or into country, just to go, I have to go see this client. I just need a desk for the day.
Absolutely.
Like you don't have that if you're kind of stuck at, Martin Place on a floor.
Yeah, absolutely. They're actually winning a lot of enterprise clients now with, multi-thousand seat deals. And that's really interesting. I mean, that was the WeWork vision. It never really played out. It was more smaller startup. They're winning these big enterprises now. They're winning companies that have 100,000 seats. They're winning 3,000 seats, and they're packaging this up. People say, it might be a multinational who bases themselves for Australia and Sydney. And if they're going to Adelaide or Perth or Melbourne for the day or Brisbane, they've got a seat.
It's amazing.
Pretty good deal. Same price.
But it's not just a seat. It's you got to go see a client. You need a professional setting. Well, there you can book
You've got an
boardroom
office.
and
You
got a
can
meeting
book
room,
a
and
meeting room. Exactly.
yeah, it's amazing. It's absolutely amazing. Yeah, look, it's been great chatting to you. I appreciate it. The other question I always have is when someone's running 60 to 70 stocks, and a lot of the companies you've said are quite fascinating. How do you go about managing the assets in the portfolio? Like, do you think of every position as directly in the position, or when you look at it, do you look at the thematics and go, I would like percentage weighting towards one sector, and then you go try to find the five companies
Yeah.
in order to be in that space. Like, how do you actually manage, what comes in? And then, like, as an example, okay, now's the time we need to be out of this sector. Does that mean you exit out of the five companies in that particular sector? Or, how do you actually manage that?
Yeah. So what what I do here is, you know, play risk first. So the most we can own in a stock is based on the risk grade: high, medium, low, or max, right? Max risk. And that will determine the weight. And then you've got portfolio risk constraints that you place on yourself, which are really, as I mentioned at the start, trying to follow the bench as your starting point for what you own. Now, if you look at any given point, for example, at the moment, I'm half weight in industrials, which is a big sector, so 9% versus 18% of the benchmark. We'll take those tilts, but I'm looking to take them in ways that are correlated. So in that case, it might be something that plays into a global cycle. If I was underweight consumer staples, because I think all the supermarkets are bringing in their private label, there's unlimited shelf space online, their marketing and media moats that they've always had it disappearing. I might move into infrastructure, right? Something also defensive. So you've got those constraints. After that, I'm actually just optimizing for how much money do I make. I'm not optimizing for a theme playing out or whatever. So typically what would happen is if we're doing the right thing, it would be if you want me to answer the question as a theme. So I'm not actually worried about them. I think they're interesting because you're finding change and that's how you make money. That's how things are mispriced. But I would say a theme is played out when the stocks start to trade for what I think they're worth. That's my investment horizon, right? The theme itself may have another 10 years to go. But if it's priced by the market, it's priced by the market. So that's how I go about it. Once your expected return on a stock drops, you don't expect to make a lot of money. You want to fill that spot with a stock that you think you can make a lot of money from within your risk parameters.
Yeah, that's really interesting way of doing it. I don't think I've heard it explained that way before. James, it's been really good having you on. I'm going to dig into this portfolio a bit more because I think it might work handy with something else that we're also currently using. But is there anything else that you want to say to the listeners before we hop off the air?
No, not at all. Thanks. I think they've been good questions, Murdoch. Pretty relaxed chat. Look, if you want to reach out to Antipodes, you can reach out to us direct or via Pinnacle, as always, and there's more details on the fund there. I try to keep people somewhat updated on LinkedIn, so add me on LinkedIn and you'll see information on the fund also posted.
Excellent. So, what's your what's your web address? What's the best web address for people to get more information?
Yeah, Pinnacle's address would be pinnacleinvestment.com.au, I think, and Antipodes is antipodes.com.au. And I think the email, you'll see the email addresses on the websites.
Excellent. If anyone out there wants an understanding of how it actually fits within your portfolio, please give us a call at yorkwealth.com.au. But James, thank you very much for coming on and look forward to speaking to you soon.
Great. Thanks very much.
The Rate of Change podcast is presented by its speakers. The views and opinions expressed in this podcast are those of the speaker in their personal capacity and do not represent the views of York Wealth Management Proprietary Limited, its shareholders, directors, or any other third party. Any discussion of financial products, investments, credit, or property opportunities in this podcast is provided strictly for general information and discussion purposes only. Nothing in this podcast constitutes general advice, personal advice, financial product advice, credit advice, or a recommendation. Before making any financial or investment decisions, you should seek advice from a licensed professional who will consider your objectives, financial situation, and needs. Australian listeners can obtain further information about choosing a financial advisor by visiting www.moneysmart.gov.au. For clarity, the Rate of Change podcast is a business owned and operated by Murdoch Venture Capital Proprietary Limited. Any client relationship or referral that arises through the Rate of Change in connection with services outside the scope of financial services requiring an Australian financial services licence, including, without limitation, private credit, property development, or other non-AFSL activities, shall remain the sole property of the Rate of Change. Where listeners wish to obtain advice in relation to their investments or other matters that fall within the scope of financial services requiring an AFSL, the Rate of Change may refer them to York Wealth Management Proprietary Limited. York Wealth Management is referenced in this podcast solely in its capacity as sponsor. References in the introduction to the Rate of Change with York Wealth Management are sponsorship acknowledgements only and do not imply ownership or control of this podcast by York Wealth Management. To learn more about York Wealth Management as sponsor, please visit www.yorkwealth.com.au.